Welcome to this webinar on understanding the value of your business. My name is Trevor Hood and I work with the owners of private businesses to understand and maximize the value of what is often their largest and most important asset, their business. I am a chartered business valuator, a designated expert in the field of business valuation, and manage the business valuation and corporate finance practice of SP Partners Chartered Accountants. This webinar series is being brought to you by the York South Simcoe Training and Adjustment Board. The board is a non-profit entity funded by Employment Ontario with a mandate to help maintain and facilitate the growth of the local labour market in York Region and South Simcoe. This series of webinars will focus on a team approach to planning transition, covering such areas as preparing a transition plan, steps for determining the net worth of your business, and steps for moving the business from you, the present owner, to another owner while maintaining goodwill. The 4 webinars on the website exemplify the team approach. They are financial planning, determining the present owner's financial stability for the future in preparation for succession of the business to another, business coaching, moving the business from the present owner to another, thereby separating the business from the person and maintaining goodwill. Legal, some strategies for transitioning of ownership and around negotiating price. And finally this one, business valuation, determining the net worth of a business. For the webinar today, I want to walk you through what we refer to as the art of business valuation. And in doing so, we will cover off the concepts of price and fair market value, an overview of the primary methods used in the determination of value, specific details on the earnings-based valuation methodology, and finally, I'll touch on how a chartered business valuator can help you through each phase of the succession process. So what is value? When one looks at value, there are 2 key concepts to consider, and these are fair market value and price. Fair market value is generally the concept that is applied when preparing formal valuation reports, and is defined within the business valuation profession as the highest price obtained in an open and unrestricted market between informed and prudent parties under no obligation to act, expressed in terms of cash or cash equivalents. Basically, this definition describes the value that someone off the street would be willing to pay in cash for your business under the assumption that everyone has equal information and a desire to transact. Price, on the other hand, is something that can only really be determined as part of a negotiated transaction between 2 parties to buy and sell an asset. That negotiation of price is the subject of one of the other webinars in this series. With these concepts, the best way to understand them is to consider what I refer to as the building block model of value. Under this model, there are 3 building blocks to consider, with the first 2 building to represent fair market value, and the third representing the block that normally distinguishes fair market value and price. The first building block is what I refer to as tangible asset value. It is the so-called assets that you can touch and feel, such as accounts receivable, inventory, and equipment, minus the liabilities and obligations of the business. The tangible assets serve as the foundation of this model and represent the minimum value of a business on the basis that, in a worst-case scenario, the business owner should be able to liquidate these net assets and realize the tangible asset value on the liquidation. The next component is the business goodwill and intangible value of a business. Value within this component depends on the nature of the business, as this value can be related to the location of the business, the name and reputation of a business, the brands the business has created, or certain intellectual property that has been developed by the business. Furthermore, goodwill and intangible value depends on the following. First, the value is primarily a function of the cash flow generating ability of the business, as a potential purchaser will generally require a rate of return on any investment that they make. Secondly, the goodwill is dependent on the risks associated with the cash flows being generated by the business. For example, if a business has one customer that generates 90% of its revenues, then there is significant risk related to the business's earnings, and this would in turn impact the level of goodwill. Finally, the key to goodwill and intangible value is that it is tied to the business. To start, this means that the business has legal ownership over any intangible or intellectual property. In addition, a key point that specifically pertains to privately owned businesses is that the goodwill cannot be personal goodwill, where it is tied to the business owner. Personal goodwill occurs where an individual is critical to the business, and without them the business would likely fail. The conversion of personal goodwill into business goodwill in preparation for succession is discussed more in length in the business coaching webinar of this series. Examples of personal goodwill include where the business owner is integral to the business's customer relationships or holds the key to the business's intellectual property. The final block is one that is generally not considered as part of fair market value, but is definitely a very important part of price. This block is referred to as special purchase premium and represents the incremental value that a certain strategic purchasers were willing to pay because of some advantage that they will be able to realize with the purchase of the business. These advantages are generally related to economic synergies, such as cost savings or incremental revenues that the purchaser would be able to realize from combining the business with their own. For example, our firm recently worked with a client who was in its early growth phase, but probably received double the fair market value on sale due to the fact that the purchaser was a European company who was looking for a footprint in North America. The purchaser was willing to pay the higher price in order to avoid having to start a North American operation from the ground floor. Given this understanding of value, we can now turn to how you value a business and the different approaches that are used. The three primary approaches that I wanted to cover today are asset-based valuation approaches, rules of thumb, and earnings or cash flow-based approaches. As the name suggests, asset-based valuations are based on the underlying assets and liabilities of a business. This type of approach is geared for businesses where there is no perceived goodwill, and this lack of goodwill can be for a number of reasons. To start, the approach may be used for certain companies who are underperforming and thus not providing a sufficient return on investment given the risks associated with the business. For example, we had a client in the steel industry recently that was generating significant positive earnings, but due to the shortage of steel supply, had such a large investment in inventory and its manufacturing assets that we determined that the company was not generating enough of a return given the risks associated with the business. In addition, certain industries will see valuations based on this approach. The primary example is the construction industry, which commonly utilizes an asset-based approach due to the fact that their revenues are primarily generated through tender-based projects, where the name or reputation has little impact on successfully bidding on projects. In these cases, a company's future success is totally dependent on its ability to successfully tender the next project. Another example is investment holding companies, where there is obviously no goodwill value, but the value is based on the underlying investments that the company holds. The final applications of this approach is where goodwill is considered to be personal in nature. While the personal goodwill scenario can apply to a number of different businesses, it is common with professional practices where the revenues are tied to the professional. In particular, this is often the case with lawyers or medical specialists. Rules of thumb are the second methodology I wanted to cover, and these represent industry-specific valuation guidelines. These rules are normally based on a certain multiple of revenues or other easily determined basis. When looking at rules of thumb for your specific business, the starting point is normally an industry association. Most of the larger associations can provide you with this information. In addition, there are some specialized publications that provide various rules of thumb and other industry-specific information. As an example, a publication that I utilize indicates that the rules of thumb for valuing a travel agency is 35 to 45% of annual sales, with the percentage depending on the size of the travel agency. Now, the great thing with rules of thumb is the general simplicity with which they can be applied. However, the ease and simplicity with which they can be applied can be somewhat dangerous. For example, if the rule of thumb is 35% of annual revenues for a particular industry, and you have two companies that are generating $500,000 a year in revenues, then you would theoretically be willing to pay $175,000 for each business. However, let's assume that company number one is running extremely efficiently and is generating $50,000 in after-tax profits, while company number two is good but less efficient at $30,000 a year in after-tax profits. Would you still be willing to pay the same price for both companies? Probably not. Thus, I would suggest that rules of thumb are a good starting point, but that the underlying profitability and cash flows are the true driving force behind the value, so that the rules of thumb should be used with caution. The final and most predominant valuation methodology is what I'll call the earnings approach to valuation. Because of the predominance of this model, I wanted to cover this in a little more detail than the other methodologies. With the earnings approach, there are a couple of variations, but for the most part, they involve the same principles and only utilize different assumptions. In the marketplace, you'll hear people talk about earnings multiples, EBITDA multiples, and with this, they are applying an earnings-based valuation. In applying the methodology, there are two key drivers to value, the earnings and the earnings multiple. With respect to earnings, the first consideration is the type of earnings to use, whether it be among others, after-tax earnings or EBITDA, earnings before taxes, interest, depreciation, and amortization, as you briefly may have heard about when you viewed the webinar on price negotiations. This choice depends on the nature of the company's operations and certain other specific factors. For example, manufacturing companies are normally valued using an EBITDA or cash flow earnings level. This is due to the fact that capital reinvestment is a key consideration, but is something that is not considered in the reported earnings of a manufacturing company. Conversely, in a distribution business, the reported amortization is generally equivalent to the capital reinvestment, so that the after-tax earnings can be used to approximate the cash flow generating ability of that business. Also with earnings, an important aspect is that the earnings are normalized. By normalize, we mean that the earnings are adjusted for unusual or non-recurring items and also for discretionary items that are common with small businesses. Discretionary items include excessive management compensation or wages paid to family members, and also any personal expenses that have been paid through the business. With this normalization, we are attempting to estimate the annual future earnings of the business available to a prospective investor, since it is the future earnings that will represent the return on investment that a potential buyer will receive. Given the uncertainty with future earnings, I normally consider a 5-year history of the business's earnings so that I can identify the trends and get a better sense as to the future prospects of the business. The second key component to the earnings-based approach is the earnings multiple. This multiple is a function of the inherent risks associated with the earnings and the business. In addition, these multiples are linked with comparable rates of return in the marketplace, such as what you can earn in a government bond or in the stock market. In simplistic terms, the best way to describe the concept of a multiple is with the following example. If you, as an investor, had $100,000 to invest and decided to invest it in a business that provided a rate of return of 25%, then you would have an investment that is generating $25,000 per year. Earnings-based valuations apply this concept in reverse by first assessing the annual rate of return. The risk is then assessed as compared to being able to earn 4% in a government bond or 10% in the stock market, and the earnings are divided by the expected rate of return to arrive at the level investment or purchase price that an investor would be willing to make. In the above situation, if the expected earnings from a business were $25,000 and the expected rate of return was 25%, then the $25,000 divided by the 25% brings us back to the $100,000 required investment. You will also note from this example that dividing the earnings by the 25% rate of return translates to a multiple of 4 times the expected earnings of the business. Now I must stress that this is a much simplified explanation of the earnings-based approach, as there is significant technical expertise and knowledge of the marketplace that need to be considered in the valuation of a business. These include the way the business has been financed, any non-operating assets of the business, and the industry in which the business operates. One must also consider factors specific to the company, such as reliance on key customers or suppliers, dependence on key employees, and the level of infrastructure, systems, policies, and procedures that are in place. With these complexities, this is where a chartered business valuator's experience and expertise can provide assistance to a business owner to help them understand the value of their business. In the financial planning webinar, you heard about a succession transition model with 3 phases: pre-transition, transition, and post-transition. The understanding of business value is one of the critical first steps of the pre-transition phase of a succession plan, as it will allow the business owner to understand the saleability of their business and the potential dollars that they are dealing with for their retirement and estate planning. With this understanding, the business owner can also then work with a chartered business valuator to identify opportunities to enhance the value of their business in the 3 to 5 years preceding the sale. These opportunities might include the diversification of the company's customer base or the development of management infrastructure to reduce the reliance on the owner of the business. In the transition stage, a Chartered Business Valuator is an integral member of your multifaceted team that you should include among others your lawyer and accountant who will guide you through the presentation, negotiation, and eventual divestiture of the business. For more information on Chartered Business Valuators, I would recommend that you go to the website of the Canadian Institute of Chartered Business Valuators. In closing, I recommend that you take a few minutes to watch the rest of the webinars and do the small quiz accompanying these webinars on the website. You'll gain some more insight into some of the other various aspects of succession planning, whether it be regarding financial planning, business coaching, or how to negotiate pricing of your business for sale. Hopefully, this particular webinar has provided you with some of the basics so that you can better understand the value of your business